heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde of Bloomberg's world headquarters in New York.
And I'm Ed Ludlow in San Francisco. This is Bloomberg Technology.
Coming up, Disney's fight against activist Nelson Peltz. Well, it steps up as it has a win of support of ValueAct Capital for its board nominees. We'll break down the latest.
Plus, Bitcoin reverses course and wipes out gains from this year as uncertainty lingers around the SEC's ETF decision. More details ahead.
And is 2024 the year US-China tensions finally hit Apple? We'll discuss that and so much more throughout this hour. But first, we check in on the markets and the macro picture. Perhaps some of the data not coming in as strong as had been anticipated. Is that good news for a Federal Reserve? Or is indeed we can start seeing the cutting process come sooner as the market wants to see? Fed Barkin, of course, a voting member, he wasn't giving us any particular hints on exact timing of a Fed rate cut, but the Nasdaq is still off by a percentage point, so still some reconsideration of how much tech stocks should be valued at in this current macro environment. The 10-year yield up some 2-3 basis points, coming off of its highs, at one point eclipsing 4%, but then that slightly weaker data just pulled back on the sell-off in the bond market. Bloomberg Dollar Index, though, now up for a fourth straight day, so clear signs that maybe the market has misjudged how much we will cut into 2024. Moving on, look at what's happening in the world of Bitcoin, because there has been volatility, Ed. There has been a sell-off at one point, really eroding down to just over 41,000. We're well off the 45,000 that we were at just yesterday, but still at $43,000 level for Bitcoin, all in anticipation of whether really the January 10th deadline will indeed give us some sort of spot Bitcoin ETF. More on that in a moment, though.
Yeah, we're going to dig into that big time later in the show. The kind of main story on the public equity side is Disney. Disney CEO Bob Iger has secured the support of activist ValueAct, who will back Disney's proposals for the board. At the same time, a very small activist hedge fund, Blackwell's Capital, has some other proposals for board nominees, but is in line with Bob Iger. That support important because Bob Iger is trying to ward off Nelson Peltz and Trian Capital, another activist who have not been happy with Disney's business performance over the last 2 years. The stock essentially flat. You can see the kind of volatility in trading throughout Wednesday's session. Let's get down into detail, bring in Bloomberg's Lucas Shaw, who leads our screen time coverage. I guess, Lucas, what is the need to know here of this morning's developments and statements?
Well, it's further proof that, I guess let's start with, it's a really unusual situation to have a company of this magnitude with all these different activist investors swirling and agitating. But there's been some questions as to what exactly Nelson Peltz wants and what they're seeking from Disney, because it seems like Disney has been doing a lot of the things that they have advocated for. And then the appearance of ValueAct and now this third entity gives some ballast to Bob Iger ahead of the shareholder meeting later this year, and would seem to put him in pretty good position. And so I just think it gives Iger a vote of confidence.
So remind us, Nelson Peltz wants himself on the board and a former executive of Disney. Meanwhile, ValueAct and Disney itself want who exactly?
Well, yeah, Nelson Peltz wants Jay Rasulo, who was the CFO under Bob Iger a long time ago, and once was thought to be a potential successor. Bob Iger ended up sort of anointing Tom Staggs as a successor instead. Tom Staggs didn't end up succeeding Bob Iger because Bob Iger didn't want to go anywhere. But unlike Jay Rasulo, who clearly has an axe to grind with Iger, Staggs and his counterpart Kevin Mayer, who has also been, at one point in time thought he might succeed, have been happy to advise Bob a little bit. Kevin Mayer more so. Bob is basically saying, let me do what I'm doing because we have a plan. We've already added some board members recently who are proposing board members who are going to join. And so he thinks that his candidates are just fine. That includes, I believe, Gorman from Morgan Stanley, and then someone who used to run Sky.
We keep an eye on the comings and goings when it comes to personnel. Lucas Shaw does it so brilliantly for us. We thank him. Meanwhile, let's get to the intricacies of ultimately what this means from a business case for Disney, a valuation case, and more broadly how it fits into the consolidation we anticipate within media for 2024. Geetha Raghunathan is with us from Bloomberg Intelligence. And Geetha, just already, Lucas made that point that a lot of the work that Bob Iger's been doing seems to be in line with where activist investors have wanted. 8,000 jobs eliminated, $7.5 billion of costs removed. What more could investors want right now?
Yeah, I mean, he has done a lot of the things, obviously, that the activist investors have wanted. And you're absolutely right in terms of cost cuts, in terms of right-sizing content expenses. They've brought down content expenses from about $30 billion to $27 billion to now $25 billion. And I think the biggest takeaway, Caroline, from the latest earnings call was that they're getting their free cash flow back to pre-pandemic levels. So free cash flow for 2024 expected to be $8 billion. They're also restoring the dividend. So there's obviously a lot that they're doing. But I think there is still some frustration with Disney's management, because we do know that Bob Iger last year had spoken about how the linear TV assets are in secular decline, and he had kind of spoken about how the future for those are very bleak, but we've not really seen any concrete action from him in terms of what he's going to do with those assets. And I think that's leading to a little bit of frustration. Plus, of course, you have the studio. We've had a whole string of misfires, whether it's the latest Marvel's movie, just not kind of living up to what we expect from Disney. And so they obviously have to do a lot of work on that front as well. But we have to remember, I mean, these things are going to change takes time. It's not going to happen overnight. But you're absolutely right. Bob Iger is definitely, I think, the right person to do it. There's a lot of confidence. But again, it is going to take a while.
Blackwell's saying exactly that in a statement. As a statement, shareholders deserve the opportunity to continue to really support Disney's turnaround and transformation under Bob Iger. Meanwhile, though, Nelson Peltz says one of the issues he has is compensation misalignment, governance and succession, which he says have been issues that have plagued the company for decades. What more could be done on those three, do you think?
Yeah, I think, succession obviously has been this constant pain point for Bob Iger. But, he's brought in, the CFO was a lingering issue. They obviously have Hugh Johnston now in. And they have a whole slew of board members that they just actually brought to the board. I mean, Lucas just pointed out Jeremy Darroch from Sky, who has a very rich experience in terms of content distribution, content creation. And then, of course, you have James Gorman, who's a real heavyweight. So they obviously can get a lot of perspective there. I think they have all of the things in place. We have to really see what they do in terms of strategic direction for a few of their assets, especially ESPN, and then the outstanding ownership issue with Hulu.
Geetha, this is the ValueAct thesis on Disney. They basically state Disney's the world's leading entertainment company. They talk about the IP, they talk about the parks business, and they say in the statement this morning, as legacy technologies transition to digital platforms, we believe Disney can lead the media industry forward. Does Bloomberg Intelligence share ValueAct's thesis around Disney?
Absolutely. Disney has the best in-class brands. There is no doubt about that. Yes, we have seen a little bit of underperformance, as I just spoke about in terms of the studio side, but they absolutely have all of the levers in place. I mean, you look at the media assets, they have fantastic properties, whether it's Marvel, whether it's Pixar, whether it's Star Wars. They have all of the franchises that people love. And then, of course, you have the parks business, which has been performing extremely well. I just don't think they're getting enough credit for it.
So the question is what happens next, right? Blackwell's has some different board proposals. ValueAct is backing Disney's proposals for the board. There will be a shareholder meeting. If you sort of game planned and modeled the scenario where Nelson Peltz is appeased, I think we said that all year last year, didn't we, Caroline? Appeasing Peltz, does he get appeased based on the reporting you've read this morning?
Yeah, it's going to be, I think he's going to fight really hard. I mean, this is going to be a really contentious fight, I think, between Peltz and Disney. He obviously does definitely want to put himself on the board. He definitely wants to see Jay Rizzullo on the board. I don't think Disney kind of needs that distraction right now. It really is going to come down to what I think Bob Iger, he's obviously been shoring up his defenses with the ValueAct news, with the Blackwell's news. it's going to come down to, if he can announce something, if there are any near-term catalysts in terms of strategic initiatives that can kind of really appease Nelson Peltz, whether they can come up with something on the linear TV side, in terms of plans for those linear TV assets, or if there is some kind of announcement with respect to ESPN. We know that they've been kind of searching for that strategic partner, one of the big digital players, or maybe even the leagues themselves.
Right.
Those talks have really not gone anywhere. So again, if anything comes up on that front, I think it really does kind of reinvigorate the stock price a little bit.
Geetha Ranganathan with really detailed analysis from Bloomberg Intelligence of what Lucas Shaw called a highly unusual situation with activist investors. Sticking with activist investors, another story we're tracking, gambling group Entain named the CEO of activist investor Eminence Capital to its board, as shareholders have been pushing to improve the British company's performance. Eminence, which holds Entain shares, has been critical of the company's deal-making approach and suggested they could explore divesting some or all of its stake in the US betting joint venture BetMGM, which it co-owns with MGM Resorts. Kara, what you got?
Oh, those activists are active. Meanwhile, Apple's also pretty active, and it's been able to skirt the worst of the tech battle between US and China thus far, but well, may that no longer be the case in 2024, Ed. We're going to be discussing how the iPhone maker could really get dragged into these geopolitical tensions. That's up next. Meanwhile, look, just check in on the stock, because it's once again shedding value. It was off by $100 billion in terms of market cap yesterday, another $30 billion being eroded today. We're off by 4.6% over the last couple of trading days after Barclays, of course, went underweight this stock, really thinking about some of the concerns for demand for iPhone 15 and then 16. We'll dig into the geopolitics of it all next. This is Bloomberg Technology. Let's talk about China-US, because one key American company, it's kind of been able to navigate the rocky relationship between Washington and Beijing, and it's been Apple. But mounting tensions between the two superpowers, they're making things ever more complicated for the company. And Bloomberg Businessweek columnist Max Trafkin has a story out just about this, and ultimately, what is changing? There seems to be two key issues at stake that are going to make Apple's life difficult.
Yeah, absolutely. So the two issues, number one is competition. So Huawei, which, the big Chinese telecom manufacturer for years was hobbled by these export controls instituted under Donald Trump, maintained by Joe Biden. And last year, they came out with a new phone, the Mate 60 Pro, which has a chip that is pretty close to the state of the art. It's really the first phone in a couple of years that's come close to the iPhone, potentially competitive. And then on the other hand, you have restrictions. So you have the government preventing people in China from bringing phones into the workplaces of state-backed companies. And these two things together are a real problem for Apple, because you have the government telling people not to use it, and then all of a sudden some real, genuine competition presenting itself.
Max, this is a chart that shows the sort of breakdown of revenues by geography on a quarterly basis. And I think back to November on the earnings call, where China overall was soft. And the narrative from executives was this was simply to do with Mac and iPad, because there were no new Macs or iPads. But the caveat that Apple tried to put in there, that green bar on the right-hand side, being propped up by a record for iPhone sales in Greater China. In your piece, which you title in 2024, the year US-China tensions finally trip up Apple, is it the iPhone specifically that is the battleground here, or is it the whole business over in China?
I mean, certainly the whole business. And we should just take a few steps back and say, Apple is completely intertwined with China. It relies on China for its supply chain, and it's also, as that chart you're showing shows, a substantial part of the sort of consumer-facing business. The growth of the Chinese market has been very good to Apple. But when you talk about Apple, the iPhone dominates, and it matters a lot here. And again, these are sort of faint signals that we started to see last year. When we talk to analysts, they're seeing, first of all, growth in Huawei's sales, and they're expecting at least some pain for Apple in China. But again, it's not clear how much, because Chinese consumers still, love this company. They still love the iPhone and have still been buying it. I mean, as we wrote in the story, there were, lines at Apple stores in December, even as these restrictions were being reported by Bloomberg and others.
It's an interesting test for Tim Cook in particular, right? Because he was the supply chain guy before he became the CEO. And in many ways, yeah, they're eyeing India, but they haven't stepped away from China.
Well, part of the problem that Apple has here is they are a major employer in China. So this is a political issue in China. China does not want them to necessarily diversify their supply chain, while Apple at the same time, would very much like to not be totally dependent on a country where, as we saw during COVID, as well as the demonstrations in front of these iPhone factories in 2022, that comes with risks. So you sort of have a push and pull, and some people have seen these restrictions that the government has been putting on iPhones as sort of a message from China saying, you don't want to move out of this country too much because that could create problems for the local market. So it's kind of a delicate balance, but the one thing that Apple has going for it, again, are these devices that even if they have competition, they are still genuinely loved by consumers. And when you look at the chips and so on, still ahead of what the domestic manufacturers are producing.
All right, our thanks to Bloomberg's Max Chafkin, whose latest in Business Week is a must-read. Check it out on the year ahead for Apple in China. Sticking with China, in an effort to take a softer tone on the gaming industry, China has reportedly fired the top official of the gaming watchdog agency. Bloomberg's Henry Wren is in London with more. This happened overnight US time, and it's kind of a walk back on what were strong regulations that rocked equity markets at the time.
Yes, indeed. So two media reports indicate that Feng Shixing, who's head of the China's publishing unit of the publicity department, would depart from his role. So just to caveat here, because there's no official Chinese government statement saying that Feng Shixing would depart or being fired from his role. However, this does seem that the China's gaming regulator is softening its stance toward the video game sector. Just remember, in late December, the gaming regulator published a sweeping set of curbs limiting Chinese players' playing time as well as spending on video games, and those were badly received by the market. We've been seeing a drop in industry bellwethers such as Tencent as well as NetEase, as well as other smaller video game stocks in China in late December.
Whiplash, I think, is the takeaway for now. Henry Wren, we thank you so much for the latest on what seems to be a changing of sentiment when it comes to gaming, at least for the interim. Meanwhile, coming up, look, we're going to talk all things AI and cybersecurity. CrowdStrike CEO is going to be joining us. George Kurtz, stick with us for it. This is Bloomberg Technology.
Okay, it's time for Talking Tech. And first up, Samsung is leaning into AI as the key to unlocking greater sales this year. The smartphone maker plans to launch its next flagship device on January 17th. And the teaser to the launch promises that, quote, Galaxy AI is coming. And SpaceX launched its first 6 satellites capable of offering mobile phone services with T-Mobile. Operating like a cell tower in space, the Starlink satellites work with users' existing phones rather than using specialized equipment to bring connectivity to remote areas. Plus, Atos is in talks to sell its big data and cybersecurity business to Airbus for as much as 1.8 billion euros. That's about $2 billion US. This as the French tech company faces hefty debt repayments. Atos shares fell following the news. Caro.
Yeah, let's stick on the area of cybersecurity and really what it means for 2024. Some of the risks, maybe some of the rewards. CrowdStrike CEO George Kurtz joins us now to really spell out what you're seeing on the ground at the moment, George. We were all thinking about artificial intelligence as not only a threat in terms of cyber, but also defense too. How are you seeing generative AI come into your playbook at CrowdStrike?
Well, when we think about AI, that certainly was the hot topic of 2023. And as you mentioned, it certainly is and can and will be used for nefarious purposes by the adversaries. But when you think about companies like CrowdStrike, it really is a key part of our success going forward. As we spent a lot of time on something we call Charlotte AI, which is our generative AI play in terms of helping customers really protect themselves and leverage the collective knowledge of CrowdStrike. But more than just a chatbot, actually do work on behalf of our customers using our technology. So we think it's a game changer, something that can take 8 hours of work and turn it into 10 minutes of work for a security analyst. And we think we're going to get better outcomes for our customers. So we're really excited about it, and it's a big part of our playbook going forward.
And keeping humans in the loop when it comes to Charlotte AI. I'm interested in whether you can pinpoint any real areas where generative AI has made a real impact in terms of cyber threats. What have you actually seen?
Well, there is this concept of dark AI, and that is you can think about using something like ChatGPT without Rails, right? Fraud GPT, as an example, is some technologies that are out there where you can essentially leverage AI to create things like phishing emails, to research vulnerabilities, to automate sort of the creation of cyber crime campaigns. So what it really does, though, and if you think about generative AI and what it's done for everyone else, is it takes this collective knowledge and sort of makes it available to the masses. So the challenging part that we have now is it makes cyber attacks even more available to maybe folks who don't have all of the knowledge but can actually ask a generative AI technology to do something on its behalf. So cybercrime is going to be even more and more prevalent than it is today.
George, 12 months ago, almost to the day, you and I sat down in Las Vegas at CES, and what transpired over the course of 2023 were large-scale attacks. I think you guys call them big game hunting in your tracking of these kind of scales of attacks. And going into 2024, that's continued. What are the reasons behind that? Why are you seeing a resurgence and continuation of the wide-scale attack?
Well, it's the old adage, you go where the money is, right? There's a lot of money in these cyber attacks because the adversaries have been so successful in being able to ransom and get paid. And when we think about what we saw over the last year, and you and I talked about it a year ago, you're spot on at CES, it was really the fact that we saw this sort of double extortion, which was the adversary could encrypt all the data and basically pay you to unencrypt it, or if organizations, which they have gotten better and they backed up their data and restored it, they would take a copy of it and then they would then leak that. So that was the extortion piece, right? So we saw a lot of that in 2023. And now I think it's the triple threat. We're seeing now the SEC rules coming in. And in fact, we've seen adversaries not only encrypt, but also go to the SEC as a way to get companies to pay quicker because of the 4-day rule they have in terms of reporting. So now it really opens up the aperture for the adversaries.
CrowdStrike CEO George Kurtz, it's a great way to kick off 2024, though I would say the conversation around cyber and the threat hasn't stopped at any point. Kara and I, 2 days into the new year, thank you so much for your time. Now, coming up on the show as we await the SEC decision on a spot Bitcoin ETF, we're going to discuss what to expect from the asset with Fadi Abu Alfa, head of research for Copper, a custodian of digital assets. From SF and New York City, this is Bloomberg Technology.
Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco. We're halfway through the trading, Jade, so let's get a check-in on markets. Always go to the NASDAQ 100. It's a kind of more focused index that distills down some of the factors that are happening. The NDX down for a fourth straight session. Longest run of decline since the end of October. We get Fed minutes later this afternoon, so there's kind of a countdown or trickle to that. But investors certainly pulling out of technology stocks. Of course, we talked about Apple earlier in the show, that being a big drag from a points perspective on the index. And it kind of is an example of the worries about tech. We had a great year in 2023. Maybe there is some profit taking and selling heading into the new year, but the pressure is quite clearly there in the short term and for the time being. Caroline did a great job at the top of the show, also talking about Bitcoin. Volatility in the session, it would be foolish to say there is a clear causal link or catalyst because there is a lot of news reports out there. All told, Carol, I think what we're doing is taking stock of where we are or are not with Bitcoin ETF applications and the decisions that the regulators will or will not take.
Precisely, and headline risk ahead of that. Someone to help break us down whether this volatility is to be expected. Fadi Abu Alfa is with us, head of research for Copper. Now, that's a custodian of digital assets, and you in particular focus on markets, on blockchain-based financial market infrastructure. So, Fadi, should we anticipate this sort of volatility into a key date like January 10th, when indeed we all feel the SEC has to make some view on a couple of ETFs and therefore maybe all of the ETFs?
You know what? It's an interesting question about time. If we were talking about this a year or two ago, we'd be wondering whether an ETF would ever be approved. Now we're talking about when will it be approved. So we're a lot closer to a very important moment in cryptocurrency's history. The when it's going to happen isn't really that important. We know that it will happen. We know that BlackRock has a very great track record in getting their ETF applications approved. So there's not really much worry about it getting approved at this point. The when is going to be something that markets are going to look at, and it's going to cause a little bit of volatility. And for traders, that's great. They want volatility. For the long-term investors who want to actually buy the ETF, they're going to just hang on a little bit. That's all.
Fadi, Caroline and I always say on this program, Bitcoin is our risk asset of choice, and sometimes it moves in close correlation with equities, sometimes it doesn't. But you do note that there is some volatility in selling in markets broadly, particularly on higher or stretch valuation tech stocks. How much of this is just going into the new year, new markets, fresh perspective?
You know, you mentioned NASDAQ, and if we were looking at this again a couple of years ago, we're going to say that Bitcoin's now trading again like a tech stock. And actually, if you look at on a weekly basis, the correlation with the S&P 500 is at its highest since May 2023. So the correlations are still there, but Bitcoin isn't going drastically down as we've seen with the NASDAQ over the past couple of days into the new year. So Bitcoin's actually doing quite well, even if it's seen a little bit of volatility today on the back of some not so vetted news.
Yeah, I think I know what you're referencing. And Fadi, I would say this to our audience. This is less than scientific, but I've seen posts on X, other blogs, that make the argument that actually Bitcoin currently is not pricing in a roadmap for approval on Bitcoin ETF. Are you able to make that argument that the price of Bitcoin, even the surge of recent weeks, could not reflect that potential outcome?
I think we're still at a state of a little bit of gambling in crypto markets. There's still a lot of leverage in the system. If you look at potential cash and carry trades, if someone wants to take a near risk-free return, you're looking at 15, 20%. But the reality is for that you to take advantage of that, you need to buy the spot market, put it in under custody, trade it on global markets, and take advantage of that yield. The reality is, what happens when these liquidations occur is that people will have to go back in, buy more Bitcoin, and do the same process all over again. So it's sort of the self-fulfilling cycle, especially when we go into a positive cycle with Bitcoin. It feeds off each other, and it does the same when we go in a negative cycle. That's all.
There's been this sort of flurry of activity, an awful lot of box ticking needed to be done with the SEC. You think of companies talking about their authorized participants that are involved to be able to create, redeem the shares within the ETF. You've got, of course, a bit of a rush for people to have overall the clear language that the SEC is wanting to see as well when it comes to cash-only creation. So if we don't get all the box ticking necessary, and if the SEC doesn't want to make a kingmaker out of just one or two ETFs, and we do hold out, and we don't see something by January the 10th, will we fade this rally? Do we have to fade this rally?
We could see Bitcoin drop as well. Yes, it's not inconceivable to see that Bitcoin can drop to 37,000. A lot of analysts that look outside the traditional markets and they look at the blockchain activity are arguing that we could see a correction to 37,000, maybe lower. If you ask me, if I look at sort of a revision to the mean, you could even argue that it could go to 27,000. But ultimately, when we're talking about the ETF approval, we're talking about long-term investors who are going to come because they don't want to manage the security of their digital assets. And so at that point, it's a completely different argument. It's inevitably going to go up. So the idea that an ETF is going to either make or break Bitcoin in the next 6 months is a little bit wrong. We need to look at who the ETF is really going to be addressing as a market, rather than investors and traders who thrive on the volatility that we're seeing today.
Yeah, and using future strategies and have been doing that for a few years when the liquidity is there, Fadi. I'm interested as to, therefore, have you quantified what sort of scale of money you think will come in as and when a spot Bitcoin ETF is approved? What sort of inflows are you anticipating?
I don't really have a number for you, to be honest with you. I think it's a narrative that cryptocurrency markets have really sort of latched onto as something positive, as a catalyst after a couple of years of really difficult things happening within the market. But what is really going to happen is that we're going to see larger investors understand that buying a Bitcoin ETF is going to be a lot more expensive than actually taking custody of their own assets. And the opportunities on a 24/7 day, round the clock, round the year markets are going to be a lot more lucrative than buying something that's traded on a US-based exchange only, or any sort of exchange traded products that's sort of locked into traditional hours. We're entering a very different financial market infrastructure, and I think Bitcoin's the start of investors understanding that digital assets offer a lot more interesting opportunities.
Fadi, your analysis is referenced in the main Bitcoin story on the Bloomberg terminal, Bloomberg.com this morning. You're listed as head of research, but Copper is a crypto custodian. So I went down the rabbit hole. Coinbase is also a crypto custodian. Explain the competition in that market and what it is.
I think we're addressing very different markets. So Coinbase is a crypto custodian, but I think it also addresses a much more retail-focused audience, and it's done great. I don't think the crypto industry would actually be where we're at without the initiative that Coinbase has put forward. Digital asset custodians, such as Copper, are focused more on financial market infrastructure and real-world digital assets, and removing and mitigating the counterparty risks that we've seen on exchanges, perhaps not Coinbase, on other exchanges that are not so reputable, that have been hacked. Whereas investors would use Copper to mitigate their counterparty risk and still be able to trade on all these exchanges. I think that's the main difference between companies such as Copper, who's focused primarily on financial market infrastructure and custody and being able to provide the tools, and Coinbase, which has a much more, not retail-focused, primarily a retail-focused outfit, but it's just a different kind of offering to the clients.
All right, Fadi Abu Alfa of Copper, great to have you on the program, Bloomberg Technology. Thank you for your time. Now, coming up here on the show, we're going to talk about the state of the venture capital industry in 2024 with Rebecca Lin from Canvas Ventures. That's coming up next. This is Bloomberg Technology.
In December, it was OpenView in Boston, and now another VC firm is shutting down. This, a solo GP, Countdown Capital. It's an early-stage investor focused on aerospace and defense startups. Founder Jay Malik posted on X that despite delivering strong performance, he believes the future of industrial VC favors larger firms than his. Firm is shutting down just 16 months after closing a new $15 million investment fund, Ed.
Let's keep it with it. Let's talk about what this means for the future. Some funds were started, some funds closed, drop off in activity. Will we see consolidation in the space? I want to bring in Rebecca Lin, co-founder, general partner of Canvas Ventures, with me here on set in San Francisco. I've been looking at this chart, VC-backed public listing values historically. 2021, a lot was going on across the SPAC space in particular, but also just traditional listings. The market closed in 2022. Caroline and I got a little bit excited towards the end of 2023, and we're trying to work out what happens in 2024. And I bring the chart up because you've been at this 10, 15 years. Series B is your sweet spot. There must be loads of portfolio companies that have matured since investment, and you're wondering, how do I get out?
Yes, exactly. I think in venture, what I learned really early is you don't time the market. What you do is you build really profitable companies built on fundamentals. And it's one of the problems we've seen over the last 10 years with this focus on hyper growth and unicorn status. It's really not what creates these very profitable, long, enduring public companies. And so I don't think the answer is, how do you get out? It's how do you create a profitable company that has options and opportunities when the window's open. And when you look at the big hits we've had, including Doximity, Lending Club, and others, they were actually profitable and growing years before they went public. And so as a company, you really want to control your own destiny. And you do that by a core focus on the fundamentals and a path to profitability.
If you look at the PitchBook data for 2023 last year, looks like we'll hit 150 billion of venture funding to drop off. But one of the kind of artificial bright spots, forgive the wording, was artificial intelligence, right? There was a lot of activity, large rounds, even at Series A, debut rounds.
Right.
Is that enough to carry momentum over into 2024, or is that now ended?
I think that will continue to some extent. So a couple things. So yes, there was a huge drop-off last year. It was 50% down from the year before. And we haven't seen that low of a number since 2015, just to sort of emphasize how much of a drop-off we felt last year. And with AI, what you saw was $1 in every $4 was invested in the AI space. I think we'll continue to see that. But I also think there's going to be a real day of reckoning, too, for AI in companies that are that need to find profitable business models. And we're seeing that, the big companies, Google, Facebook, Amazon, all struggling with how to really make AI profitable and how to work those business models, right?
And to that point, when you're thinking about the checks to write, I think of an exit that you have had, Casetext. I mean, we're seeing more and more legal AI companies come to the fore. We're about to interview another one, actually, who's just had a funding round. Are they going to be able to operate independently? Have they got enough of the data that is rich and bespoke to them to fight off, ultimately, OpenAI or Microsoft or Google just being able to replicate it themselves?
Yeah, and I think that's a great question in terms of what it really takes for an AI company to succeed. So we've had a front row seat in AI since we invested in Siri, back in sort of the first round of this, right? Casetext was a really unique situation. Casetext had been operating for about 10 years in the space with 10,000 unique clients and all the data behind that. And so they had access to the large language models for probably 6 or 7 years and had been working with it for a decade. And we're really one of the very first people in the sandbox for OpenAI because of that. So I would say not all legal startups are the same. And Casetext was very unique because they had this large customer base and the data with that. So I guess the answer is maybe. But I would be fairly concerned starting a company right now in a space without having a unique customer base and proprietary data and going up against the Googles and the Facebooks and the Amazons.
Rebecca, we came into this conversation with you talking about Countdown Capital and yet another, this was a solo GP, but another venture capital firm in and of itself shutting up shop. Is that going to happen as well? Can you speak to your own industry being forced to consolidate or having to wind down, not just the portfolio companies that you've backed?
Right, absolutely. So it's been really interesting over the past 15 years since I've been in venture. This environment looks very much like the environment in which I entered in 2008. We launched our fund when Lehman crashed, pretty much that very same week. And it's a great time to invest in companies. When it comes to venture capital firms, there are 3 times more venture capital firms today in existence than when I started in 2008. There are about 1,000 firms at that point in time, and there's approaching 3,000 firms right now. And what we have seen in every industry cycle is that venture is a cyclical industry. It ebbs and flows. It sort of peaks every 10 or so years. And what we see from that is we do see consolidation in every cycle. But what that creates are amazing firms like Benchmark and Redpoint, where sort of the best of partners and other firms join together and form new firms. And so we'll see a lot more of that, I believe, in the upcoming year or two. And that's an exciting thing for venture overall.
We just have 30 seconds left. What's the big sort of thematic area you're focused on for 2024?
Big thematic area for 2024, I really think, healthcare remains an untapped opportunity, and especially in applications for AI. It's uniquely suited for AI because there's a lot of money going into it. People are spending a lot of money to solve these problems in healthcare, and I think it's a really rich area for an application of AI.
Rebecca Lin, co-founder and general partner of Camas Ventures, and Caro, once again, somebody calling out AI in healthcare.
Yeah, we'll keep an eye on it. Meanwhile, coming up, look, we're going to do AI and legal industry. We're just talking about case text. Well, we're going to be joined by Robin AI CEO, Richard Robinson, joining us with the company's funding boost and what the next co-pilot to watch out for is. This is Bloomberg Technology. Robin AI, now it's a maker of contract management software, says it's raised $26 million in a Series B funding round led by Singapore's Temasek Holdings. Here to talk more about this, the impact of AI on the legal industry more broadly, is Robin AI CEO, Richard Robinson. Richard, great to have you on the show. And look, I mean, less than 12 months, I think it's only 10 months since your Series A. Was this opportunistic? Why did you have to go and raise the funds?
Yeah, like you said, it was opportunistic. We're seeing a once-in-a-generation shift away from traditional SaaS tools to AI. And so in light of lots of demand and a need to really expand our R&D efforts, we took the opportunity to think about raising more capital.
The Singapore angle here is really interesting. So Temasek is leading the round, but you guys also plan to open a presence in Singapore. Why?
Well, we want to be a global business. We think that the last generation of fundamental technology like the internet gave rise to massive global businesses like Google and Facebook, and we think that AI is going to usher in another generation of companies of that size and scale. And so we want to be global. We've always been significantly ambitious. We've got customers in Asia, and so we wanted to expand that presence, and Temasek made perfect sense as a partner.
You talk about this shift of SaaS to AI, and basically you're a co-pilot concept that you bring AI sort of to standard Office software. And in fact, this particular co-pilot that you're announcing and been using is free on Microsoft Word add-ons, if I'm correct. So with the customers you already have, PepsiCo, PwC, you've got a lot of key names. Where's your revenue generation coming from? Why did these VC names want in on the round?
Yeah, I think primarily our revenue comes from big companies. We sell to in-house legal teams because we want to help companies go faster. So our customers are the Fortune 500, the world's biggest private equity funds. They're people who do transactions. And I think what's got investors excited is, number one, they see that AI is changing the whole industry. You had that in your last segment. The legal industry is going to change and it's going to be transformed by AI. But number two, they're seeing a startup that has real traction with really discerning customers. And that means that we could build something quite defensible here.
We've been showing video of how Robin AI works as a sort of contract drafting assistant tool. And Karen makes a really important point. It's an add-in into Microsoft Word. But Microsoft is doing a lot with its own Copilot, right, in terms of productivity tool. Are you worried about the kind of design of the system here, that Microsoft is offering something similar?
Not really. Microsoft's product is, you're right, similar, but it's really a general tool. It's designed to do everything, a little bit like Microsoft Word is. It's a generic tool. And the legal industry is going to be worth $1 trillion next year. It is one of the biggest industries on the planet. And I think it needs its own bespoke AI system that understands legal documents, understands lawyers' workflows, understands the law. And so the Microsoft Copilot's not going to do that. It's catering to a much wider audience. We're really the best in the world at legal AI. And I think that's going to be its own race that requires its own focus.
Robin AI CEO Richard Robinson. As a law school graduate, the idea of automating drafts in the legal context, I know a few people in my world that would be very interested in that. We're grateful for your time.
No,
What a great conversation, Ed. Meanwhile, look, I mean, we're back to it. Conversations in 2024 focused on AI, focused on cyber, focused, of course, on, well, maybe some of the valuations we're seeing as well. That does it for this edition of Bloomberg Technology. Yeah, there's an element of deja vu, but recap on the podcast wherever you get yours, Apple, Spotify, iHeart, and Bloomberg. From SF in New York, this is Bloomberg.